Hello, this is Brian Bortz, one of the partners here at Kane Waters, and I am joined today by the managing director of Tectonic Advisors, Brad Sanders. Unfortunately, my partner Hunter Satterfield cannot join us today, but he told me to let you guys know that rest assured he'll be here at the end of the month for the January update. But today we are doing the December month-end update and also the 2023 year-end update for the markets. As you can see, the stock market was up quite a bit in December, and if you look at the domestic markets, the S&P 500 was up 4.5% for the month of December and ended the year up 26.3%. Global stocks were up 5.3%, so global stocks actually outperformed domestic stocks. And for the year, they were up 21.6. Really, what caught my attention was the movement in the bond market for the month of December. The domestic bonds were actually up 3.8% for the month and ended the year up 5.5%. So most of their increase actually happened in the month of December. Same thing happened with global bonds. Global bonds were up 4.2% for the month of December, and they were up 5.7% for the year. So what we wanted to talk to you guys today was really related to kind of what happened in December. We had the proverbial Santa Claus rally that happens periodically in December's, and we also had kind of a little bit of a bubble up that happened in the month of December. And really, when you look at the market as a whole, it was still dominated by the top 7 stocks. The quote unquote Magnificent Seven actually made up 30% of the index. So 7 out of 500 stocks made up 30% of the index. And those top 7 stocks also made up 2/3 of the performance of the index. So the market was definitely driven by the 7 largest companies that were up anywhere from 50% to 240% for the year in those individual names. But one thing that I noticed in December was that we're starting to see a little bit more broadening of the market. And by that, what I mean is the equal weighted S&P 500. So if you just equal weight all 500 stocks, that equal weighting actually was up more than the index was in the month of December. And that's the first time that we saw that. It's indicative of moving the markets to a more broadening as opposed to just a very, very narrow seven stocks. So with that, our expectation of the market broadening and, really what's going to dictate what happens in 2024 is going to be based on what the Federal Reserve does. And we've talked about that all year last year. The market really did move in line with Fed movements. And really, Brad, I want to kick this over to you and talk to you a little bit more about what we have as far as expectations for the Federal Reserve and for the market and the economy in 2024.
Yeah, I really think your point that the Fed's going to be the story for the first half of the year. And really, they were the story for the last couple months. I mean, the stock market was up. S&P is up 14% in November and December combined. Small caps, which have been one of our big focuses, were up 22% over that period, which was wild. And you mentioned it, the bond market, most importantly, was up 8.5% just in the last 60 days of the year. So we've just had quite an amazing rally. And a lot of that was predicated on the Fed basically coming out and kind of capitulating and say, yeah, we're probably going to cut rates next year. And so we're kind of in this limbo period now where the market went ahead and priced in 4 or 5 Fed rate cuts of the quarter point variety. So you've got the 10-year Treasury. It's gone from 4.9 at around Halloween to in the high 3s, 3.9-ish today. So that's a full percentage point of kind of rate cut expectations built into the long end of the curve already. And the stock market just went bananas and went up double digits and kind of priced in all this easing of policy. So there's a couple of things here. On the micro, the short end, this has all been good. The first couple days of the year have been a little choppy. That's to be expected. I mean, when you have markets up 14% in 60 days, nobody should bat an eye if the S&P drops 2% if you count the last day of the year, 2.5% in 3 days. Like, right, that's cost of doing business if you're gonna have markets go up that much. So we're not really concerned really with the way the year's starting at all. I mean, that's kind of to be expected. That last day of the year was probably a tell that, hey, stock's probably going to pull back. Probably people are waiting to take profits for the tax planning till the beginning of the year, things like that. But really, we're entering this interesting period where um, now the focus is solely on the Fed. They need to cut rates if they don't, because it's priced into the market. So if we start getting into the third, March, springtime, and they're kind of waffling, it's going to cause a lot of volatility because you're going to have yields pop and you're going to have some money. We basically have drug a bunch of rate cut returns forward. So those are in the market. So the Fed kind of has to meet those expectations that are already in the market. And if for whatever reason they don't, we get a surge in inflation somehow. We get some weird economic data, and they kind of say, "Hey, we're going to wait to cut." Then it's probably going to cause a lot of volatility, right? There's also a scenario where right now it's rate cuts are good for stocks. That's not always the case. It feels that way because we went through this whole zero interest rate policy where certainly zero rates and the market just kind of went up at a 45-degree angle for a decade. And it's kind of rewired everybody's brain thinking, oh, if rates are going down, stocks go up. You have to look at the causality of why rates are going down. So if the Fed's just going to ease a little bit because they've tightened too much and they've got inflation under control, that's probably a bullish signal for stocks that we can have a market that's going to be healthy and vibrant for the next couple of years. And this is an election year, so these are typically good years too, right? But you have to look at, there's a point where they start cutting rates because the economy's bad. And if that starts to happen, then it kind of breaks this correlation between rates down, stock market to the moon. And at that point, you really have to really pay attention to what you own. And to your point, that's a scenario where I don't think the Magnificent Seven can perform very well because you're going to have ETF flows driving a lot of that performance. It's kind of in a positive feedback loop now. You mentioned they're 30% of the index. Well, if you got somebody buying the S&P, they're putting a third of their money into these 7 stocks every month, and it's just kind of a self-fulfilling cycle that works in reverse. So if you have people like, oh, we got to get out of the market now, well, those are going to be the most sold stocks because they're the biggest part of the index. And look, guys, macro investing is really hard. It just is. There's very few people that do it successfully for a long time. So when you start trying to predict Fed movements and everything, and you're basically ostensibly market timing at this point because it's very, very difficult. So we prefer to focus on what we can control. And that is understanding the fundamentals of what we own, staying away from things that look like trouble and historically are trouble that get really overvalued and overowned, and let's just not own them, right? Let's focus on things that we understand a business that if we're buying it at 9 times earnings, we're going to make money in that over a long period, even if we have a recession or the Fed doesn't cut rates. We can feel comfortable owning that company through that period. We can't really feel comfortable owning something that's trading at 50 times forward sales, right? You can't do that. So we prefer to focus on what we can control. So understand our companies have wide moat fundamentals, can pass through inflation costs, aren't over levered, can withstand higher interest burden on their balance sheets, and all of those good things. And if we can kind of focus on that, we're going to get through whatever this period looks like without having to get the macro right. Because again, that's just really difficult. And I think the market has priced kind of a perfection scenario for a soft landing and what the Fed's going to do. And that's just not how life works. Life's generally a little bit more messy than that, in my experience. And so, we're kind of entering this year with eyes wide open. We do think this is going to be a good year for risk assets. It just may not be the kind of trajectory or the ride everybody wants. But we are constructive on the markets. We probably think we've seen the high in yields, which is good for the bond side of our portfolio. And, we're not going to have to spend 2/3 of the year digging out of a negative bond return part this year. We think the yield's going to do that for us. So there's a lot of positives But we don't want to take this short-term euphoria and extrapolate that out into this is how markets are now, because that's probably not the case. I would say that's a very high probability that that's not going to be the case.
Yeah, thanks, Brad. That's perfect. I mean, I love whenever I hear Brad start talking about fundamentals and being very comfortable with the things that we own in our portfolios. I think that that's really going to pay off as we look forward to 2024. So thank you guys again for listening, and Hunter will join us again at the end of this month for the January update. Thank you.